be successful at trading options, you have to understand the basics of options. Learning the basics of options can be very dry, but don't let that discourage you from learning about options. I don't trade options for excitement. I trade options to make money month after month after month. If I want excitement, I go to an amusement park or go watch a sporting event. Options to me is about making money. So if you want to learn how to supplement your income or have options be your primary source of income, you must learn the basics of options in and out. At the Dorian Way, we believe if you give us a year, we can make you into an successful option trader, and it all starts with learning the basics. So let's jump into the basics of options. At the Dorian Way, we believe learning the basics of options trading consists of learning what options are, what is an options chain, and what are the basic option strategies. So in this video, we will review the basics and provide what we consider are the key option trading definitions. So what are options? Options are contracts called puts and calls. A standard put or call represents 100 shares if trading stock options. For trading futures, it's a little different, but this is the basics of options, so we're just going to talk about the standard type of options. Options can be bought and sold at different standardized strikes on an options chain, and we're going to discuss that a little bit more in a second. All options have an expiration date. So options can expire today, tomorrow, or years from now, but every option has an expiration date. All right, so as this chart indicates, when you buy an option, when you buy a call, you want the underlying security that you're trading, whatever you're trading, whatever stock, whatever commodity, whatever you're trading, you want it to go up when you buy a call option. And that is considered bullish. When you want something to go up, when you want the underlying security to go up, that is a bullish position. When you buy a put, you want the underlying security to go down. You want that underlying security to go down, and that is what is considered to be bearish. And bearish means you want something to go down. You want the market to go down. You want the underlying security to go down. Now, when you're selling something, it's the opposite. So when you're selling a call, you want the underlying security to go down. You are also bearish, just like when you're buying a put. When you're buying a put, you're bearish. When you're selling a call, you are bearish. You want to go down, as this chart indicates. When you are selling a put, you are bullish. You want the underlying security to go up. All right, so let's jump into what is a call and what is a put option. So the buyer of a call option has the right but not the obligation to buy at a strike price. The seller of the call has the obligation to sell at the underlying security at that strike price. So let me break that down for you. If I buy a call, let's say I buy the 3,000. If I buy that 3,000, then I have the right, but not the obligation to buy whatever I'm trading at that time at the 300 strike price. So right now we're looking at the SPX, which is the S&P 500 Cash Index. If I'm the buyer, I have the right to purchase the SPX at the 3,000 strike, but I don't have the obligation. All right, so if I'm the seller, if we change this to the seller has the obligation to sell the SPX at the 3,000 to the buyer if the buyer exercises their right. So that's the difference. The buyer has the right, but not the obligation. The seller has the obligation. So let's clear this and let's move on to what is a put option. The buyer of a put option has the right, but not the obligation to sell at the strike price. All right, so the buyer of the call has the right to buy at a strike price. The buyer of a put has the right to sell at a strike price. The seller of the put has the obligation to buy at the strike price. So once again, it's just the opposite of the call. So if we buy the 29.50 put, then we have the right but not the obligation to sell the SPX at the 29.50. We have the right to sell it at 29.50. If we are the seller of the 29.50, then we have the obligation to purchase the SPX at the 29.50 if it goes past our strike price. And we're going to discuss strikes a little bit more in a second. All right, so let's jump into this a little bit deeper and go over what we think is very, very important, and that's the option chain. To be able to understand buying and selling options, you got to master what the option chain is. So what is the option chain? The option chain is also known as the option table. It is where you can buy and sell calls and puts from standardized strike prices on whatever security you are trading. The option chain consists of several different basic components that you want to understand. So for example, on an option chain, calls are normally to the left and puts are to the right. The horizontal line down the middle, this is that orange line here on the TastyWorks platform, is what is called the at the money line. The at the money line is where the underlying security is trading at. So in this case, we're looking at the SPX and it's trading at 29.76. So this is the at the money area here. Down the vertical area, down the middle vertical area of an option chain is where the strikes are at. And the strikes are standardized. And standardized means that everyone can see the same strikes, regardless of where they're at in the world. So if you're in the Philippines, China, India, New York, regardless of where you're at, if you're trading the same underlying and looking at the same expiration period, and this is the expiration period on this one is 60 days, then you see the same strikes if you're looking at the same thing. So we're looking at SPX here. So wherever I'm at, if I'm trading SPX with 60 days expiration, I will be able to see the same strikes because the strikes are standardized, okay? You can have strikes that are not standardized, or what's called over-the-counter strikes, but that's when you usually go to an investment bank like Morgan Stanley or Goldman Sachs or something like that, and you ask them to write you a non-standardized strike, and then you have counterparty risk, meaning Morgan Stanley or Goldman Sachs is your counterparty. But when you're selling standardized options on the exchange like this SPX, then you don't have to worry about counterparty risk because it's cleared by a clearing firm. Okay, it's guaranteed. So once you buy or sell something, you don't have to worry about the other side, the other party defaulting. All right, so let's move on to talk a little bit more about the option chain setup. When you are looking at the money line, which is this orange line again on the TastyWorks platform, below the at the money line on the call side is what is considered in the money, the ITM. And above the at the money line is considered out of the money, the OTM. And on the put side, which is the right side, below the at the money is considered out of the money, the OTM. So it's the opposite of the call side. And above it is the in the money. Okay, is in the money. All right, so when you're on the call side and you're out of the money is when the strike is above the at the money line. So in this case, we're looking at this 3,000 strike. So this 3,000 strike is above the at the money line, which is this orange line here. So that means we're out of the money because the strike price is above it. If we're looking at the 29.50, then this is in the money because the strike price is below the at the money line. Now it's the opposite on the put side. When we are in the money, the strike price is above the at the money line. And we're out of the money, like this 29.30, then it's below the at the money line. It's important to understand when you're in the money, at the money, or out of the money. It's very, very important because when something is in the money, you want to be aware of being exercised. Exercise means when you are the buyer of the option, you have the right to take control of the underlying security at the strike price. So exercise is primarily done when the strike price is in the money. So that's why it's important to know when something is in the money, at the money, or out of the money. Exercise can also be in cash only, but can only be done on the date of expiration. There are two types of options, American style and European style. American style options can be exercised at any time. The European style options can only be exercised on the date of expiration. If exercised, then the seller of the options must take assignment. Assignment means when you are the option seller and the buyer exercises their option, then you will be assigned the underlying security. If selling puts, will have to provide the underlying security of selling calls. So we just discussed that. If you are the seller of the put and the buyer exercises their right, then you have to purchase at the strike price on the put side. And if you are the seller of the call and the buyer exercises their right, then you have to sell at that strike price. You have to sell the shares or whatever it is to the buyer at that strike price. Let's move on and discuss another important thing on the option chain, and that's the open interest. Okay, open interest is on both sides of the TastyWorks platform. Now, you can see the same type of concept on the Thinkorswim platform. Just want to make sure you understand that. You got calls to the left and puts to the right, just like on the TastyWorks platform. And this is how the out the money line looks on the Thinkorswim platform. And this is the vertical area where the strikes are at. Just so you can understand, this is the same type of concept on both of these option specializing platforms. All right, back to the TastyWorks platform, and we got once again, the open option interest over here. Open option interest just means how many calls or puts were bought and sold at a strike price that haven't been closed out yet. So if you are looking at strike price $29.50, it just means how many calls were bought and sold at the $29.50 strike price that haven't been closed out yet. That's what open option interest means. And if we move on and look at the ask and bid on this option chain, once again, it's on both sides of the TastyWorks platform. So the ask and bid is where you can buy and sell at. You can buy at the ask and you can sell at the bid. And it just looks like this. So if we're looking at that $29.50 strike and we click on the ask, then it's going to turn it green, and that's where we buy at. Okay, and if we delete and we sell at the $29.50, then it's going to be red, and that's where we can buy at. And this same type of color scheme is going to be on the Thinkorswim platform, and it's the same type of concept. Okay, all right, so moving on, let's clear this and let's discuss Delta. Delta is very, very important, and it's on both sides as well. Delta is one of the 4 major option Greeks, and Delta is the most important Greek because Delta measures 2 things: your directional risk and your probability of success. As for directional risk, Delta determines how much you make or lose based on how the underlying security is moved. For example, if you have positive 25 deltas in XPX, you will make $25 every time it moves up 1 point and lose $25 every time it moves down 1 point. Okay, so delta determines your directional risk. So if you positive 25 deltas, that means your directional risk is to the downside, because if you're positive deltas, you want the underlying security to go up. You are bullish. If you negative 25 deltas, if you have negative 25 deltas, then you want the underlying security to go down. So your directional risk is up. You have negative 25 deltas, so you are bearish. So you want that underlying security to go down. So your directional risk is to the upside. You lose if it goes up. Okay, so that is how Delta measures directional risk. As for probability, Delta determines the probability of underlying security expiring in the money. For example, if the short option delta is 10, then it means it has a 10% chance of expiring in the money, or 90% chance of expiring out of the money. The probabilities are based on expiration. Therefore, if you sell an option at the 10 delta, it means you have a 90% chance of making at least 1 cent at expiration. If you are the buyer, then it has the inverse, meaning you only have a 10% chance of making money at expiration. So let me break that down here. So let's look at this from the at the money line. The at the money line, once again, is right here on the TastyWorks platform. And at the money, if you're the buyer or the seller at the money, that means you have a 50-50 chance of making money. It's just a coin flip. Okay, so the odds are pretty much the same if you're the buyer or the seller. Where the odds change is when you are buying and selling something out of the money. So let's look at this here on this option chain, and let's look at selling at the 40 delta here and buying at the 40 delta. All right, so if you buy something at the 40 delta, and let's click on the ask once again if you're buying, then it means you have a 40% chance of making money because the underlying or whatever you're trading has to go down past your strike before you win at expiration. Okay, if you are the seller, then the underlying security has to go all the way down past your short strike before you lose. All right, so this is a big difference from buying and selling. If you are the buyer, you need the underlying security to make a big move before you win, okay? If you are the seller of the option, then you need the underlying security to have a big move before you lose, okay? So it's a big difference. One is you need a big move before you win, and another is you need a big move before you lose, okay? So this is why we believe at the Dorian Way, being a net seller is a lot more advantageous, because the market or whatever you're trading has to have a big move before you lose instead of the other way around. So you're not gambling, you're not buying lottery tickets, you're actually playing the probabilities. So instead of having a 40% chance of winning, I want to have a 60% chance of winning. I want to be the casino. I want to have at least 51% chance of winning on everything I do. But in the Dorian Way, we normally trade stuff that has a 95% chance of winning, has an 80% chance of winning, has a 70% chance of winning. We have great odds of winning based on the probabilities, and it's all based on how options are priced based on implied volatility. All right, so let's discuss that really quickly. On an option chain, you have what is called implied volatility. Implied volatility for this right now is showing 15%, and the expected move is showing plus or minus 122 points. Okay, so that means right now the market is expecting the SPX to move up 122 points up or 122 points down within the expiration period of 60 days. Okay, and that's right now. Things can change. Volatility can increase later or it can decrease later. But that is what it is right now. So you can only control what is happening right now. So if you want to have good probabilities, then you base it on when you initiate the trade. So in this case, if we initiated at the 40% and we sold, we have a 60% chance of making money. If we sell at the 10 delta, like the example I gave earlier when I was talking about probability of success, then you're way down here, and say you sold this 10 delta at the 26.95, then this is indicating that you have a 90% chance of making money if you're the seller, because once again, this is the at the money line right here, and this underlying security you have to move all the way down here and go past your short strike before you lose. If you're the buyer, then once again, it has to move all the way down there before you win. Okay, so if you're going to buy some options, then you should buy it at least at the money or a little in the money, because then you'll have at least a 50-50 shot of making money. Don't want to buy options out of the money unless you're using it for a hedge. All right, so let's move on and let's talk about what are the basic option trading strategies. At the Dorian Way, we consider learning the following trading strategies are very important to understand the basic building blocks of options trading. This is kind of repetitive, but this is why you want to understand the basics of options. Buying an option. When you buy an option, you pay out premium. You are like the person buying car insurance from an insurance company like Progressive. When trading the Dorian Way, we primarily only buy options to hedge. It's a debit, okay? You're giving money away. All right, and this is, once again, this is buying. So if I look and try to buy this $29.50, I'm clicking on the ask and it's going to be green, okay? And if I did that same concept on the Thinkorswim platform, I looked at the $29.50, I would have to click on control first and then click on the ask, and then it's going to pop up and it's going to be green as well, as I mentioned, and this is buying of a put here. All right, so let's move back on to the TastyWorks platform. That's hit clear here, and let's move on to selling an option. When you sell an option, you receive premium instantly. You are like an insurance company writing policies for car insurance. At the Dorian Way, we are net sellers of options, meaning our portfolios always represent being the insurance company. Okay, so when you are the seller of an option, you receive monies into your account immediately. Okay, so money goes into your wallet, money goes into your purse. It's a credit to you. Okay, so it's different than being a buyer. A buyer is a liability. A seller receives an asset. You receive cash into your account. So this, if we sell the 29.50 here, it's going to be red. And that means we receive cash into our account, and we receive that immediately, and whatever happens, we get to keep that cash. Okay, if an accident happens, using the insurance company example, we still get to keep that cash, and that cash can go towards covering the accident costs. Okay, so when you're on the Thinkorswim platform, you have to click the control and then 29.50, you click on the bid, and that's going to be red for you. Okay. All right, so let's go back to the TastyWorks platform here, and let's continue on. All right, so once again, I said this is kind of repetitive so you can understand how this all works. When you are selling a naked option, okay, a naked option means selling a call or put option without having the underlying security or having a long option that creates a spread. All right, so if you sell the naked option here, let's say at the 40 delta, on the put side, it means you're not covered. It means you don't have any shares to back it up. You don't have another option to back it up. You don't have some type of underlying to back it up. It's literally naked. You're uncovered to the downside if you sell that put. And if you're selling a call, and let's say you're selling a call over here, and once again, you're clicking on the bid when you sell, then it's once again a naked call and you are uncovered. You don't have any shares to back it up. You don't have another option to back it up. You are uncovered and you have risk theoretically to all the way up to the unlimited risk to the upside. Okay, so let's look at this on a curve view so you can understand this a little bit better. All right, so let me erase one side first and let me look at this curve view. All right, so this is the put that we sold. And the put, when you sell a put, you're bullish, you want it to go up, and this is why it's showing this green area here. And when you sell a put, if it goes past your short strike, which is this, you have unlimited risk down to 0, okay? You don't have actually unlimited risk, but you have risk all the way down to 0, which can be a lot of risk depending on how big the underlying you are trading. Okay, so that's how it looks on the put side. When you are doing the call side, let me clear this for you and sell the call side. Once again, when you sell the call side, it is clicking on the bid. And we're going to go back to this curve table here, move this down. Okay, so on the call side, you theoretically have unlimited risk because the underlying security can go up into perpetuity. That seems to never happen, but theoretically you do have unlimited risk. When you're selling a naked call, you have nothing to cover you. All right, so that's how selling a naked put and a naked call looks. Let's go back to the option table here and let's click clear. And then let's now talk about a short put spread. A short put spread is when you sell a put option and buy a lower put option simultaneously. So we just looked at selling a naked put and that was uncovered. Now we can look at selling a covered short put, and this is called a put spread. So if we sell the 29.50 and let's say we buy the 29.20, which is a 30-point wide put spread, okay? And if we go look at the curve view on this, bring this down, this is saying that we are bullish. We want the market to go up, or the underlying trading to go up, because when you sell a put, you are bullish. And then so selling a put spread is bullish. All right, so we don't have risk all the way down to 0 because this put that we bought at the 29.20 is basically our stop loss. Okay, it's our stop loss. So if the market goes down and it goes past our short strike at 29.50, then we stop losing once it hits the 29.20. So that's why it is not naked. It is a covered position. It has a built-in stop loss. And this is what is called a short put spread. All right, so let's go back over to the table here, the option table here, and let's click clear. And then let's go and sell a short call spread. So a short call spread is basically the opposite of a short put spread. The short call spread is when you sell, you click on the bid, and let's do this for 40 points wide. And let's go to the curve view here, drop this down. So when you sell a call spread, you want the underlying security to go down. So if it goes down, then you win, okay? And if it goes up, then you have a stop loss at the 30-40 that you bought, okay? If it goes past your short strike at 3,000, you don't have theoretically unlimited loss potential like when you sell in a naked call, because this is your stop loss, that long call that you bought, okay? So when you're selling a call spread, you want the market to go down, the underlying to go down. You are bearish, because selling a call is bearish. We were just doing the selling a put, which is bullish. You want it to go up, so this is the opposite, all right? So jumping back to the option table, and we click on clear, and let's go over the last basic option strategy that we believe is the basics of building your option learning and understanding options as a beginner. The next option strategy is what we call the short iron condor. It is when you sell a short put spread and a short call spread simultaneously. So we just went over the short put spread and we just went over the short call spread. Now we're going to show how it looks if you sell them simultaneously. Okay, so for the best example, what we're going to do is we're going to give this a 90% chance of probability. We're going to sell the 26.95 and we're going to buy 20 points lower, so the 26.75, and we go to the call side and we're going to sell the 10 delta on the call side. We're going to sell this 31.30 and we're going to buy 20 points higher to 31.50, and we're going to look at this from the curve view. All right, so this is the curve view, and set this up for you here. All right, so when you're selling a iron condor and you're doing it at the same deltas, then you are neutral. Okay, this is a neutral position. You want the underlying security to stay between your two short strikes. So you believe the market's going to move, but you believe it's not going to move more than your two short strikes. So no more than the 26.95 on the put side and no more than the 31.30 on the call side. But if it does, you have a stop loss on the put side at 26.75 and a stop loss on the call side at 31.50. And what you can do to be able to determine how far you're from at the money, you can do a calculation to see how far you're from at the money percent wise. So you can do that on the put side and you can do that on the call side. So starting with the put side at this 26.95, you take that 26.95 and you minus it from the last trading price, which is 29.76, and that equals negative 281. And you divide that by the last trading price, which is 29.76, and that equals about 9.4% down, 9.5% down. And if you do that to the call side, you take this short strike, which is the 31.30, minus the last trading price, which is 29.76, that equals 154, divided by the last trading price, which is 29.76, that equals 5.1, almost 5.2% up. So when you are selling a stock or a stock index, the risk is normally to the downside, so you can usually get further away from the downside, because based on implied volatility, the put side allows you to get further away because that's the skew. The risk is skewed to the downside, so you can get further away percent wise on the put side. But if you have the 10 delta on the call side and the 10 delta on the put side, it's still basically the same probabilities, okay? You have a 90% chance of making at least 1 cent on the call side and a 90% chance of making at least 1 cent on the put side. Okay, so this is the concept of selling an iron condor, but when you're selling both sides, you have to add the both sides up. So when you're doing it individually, you have a 90% chance of making money. When you do it together, because the market can move in both directions, then you have to take that 10% chance on the put side, and you have to take that 10% chance on the call side, and you add it up, so it's a 20% chance. So on this iron condor structure, you have an 80% chance of making money. Okay, so there's a little different type of probabilities when you are selling both sides than when you're selling one side, because obviously the market cannot go, you cannot lose on both sides. All right, so that is the structure of selling an iron condor. We just discussed buying an option, selling naked option, selling a short put, selling the call spread. Now let's jump into some definitions that I believe are very, very important to understand the basics of options trading. So once again, this is repetitive, just so you can understand the different things about trading options. Once you get these key definitions down and understand how to work the option chain, then you can have a solid foundation to build on to be able to learn how to trade options successfully. Okay. All right. So first definition I want to talk about is at the money. At the money means the strike price is the same as what the underlying security is trading for. So we talked about that, the at the money line. So it's important to you to understand that at the money line. Buying an option. When you buy an option, you pay out premium. You are like the person buying car insurance from an insurance company like Progressive. So we talked about this. You don't want to be the buyer of an option unless you're hedging. Okay, or if you absolutely have to buy an option, you want to buy it at the money or a little above at the money, because when you're at the money, you have at least a 50-50 chance of making money. We go back over here and we look at this table. Let's clear this really quickly. And we go to at the money. At the money just means you have a 50-50 chance. The market obviously can go up or it can go down. Whatever you're trading can go up or go down. So you want to at least have those probabilities. You don't want to buy things out of the money, because your probabilities, as we discussed, become less and less. All right, so let's move back on over. So in call option, the buyer of a call option has the right but not the obligation to buy at the strike price. The seller of the call option has the obligation to sell the underlying security at the strike price. So we talked about that. If you're the buyer, you have the right to buy an option at, or to buy an underlying at the strike price. And if you're the seller, you have the obligation to sell the shares at that strike price. We prefer to be the seller, once again, because if you're selling something out of the money, the probabilities are on your side. All right, let's continue. Delta, once again, determines how much you make or lose based on how the underlying security moves. For example, if you have positive 25 deltas in stock XYZ, you will make 25 every time it moves up 1 point and lose 25 every time it moves down 1 point. Delta also determines the probability of underlying security expiring in the money. For example, if the short option delta is 10, then it means it has a 10% chance of expiring in the money, or 90% chance expiring out of the money. When you are the buyer, it's the opposite, it's the inverse. Exercise. Exercise means when you are the buyer of the option, you have the right to take control of the underlying security at the strike price. Exercise is primarily done when the strike price is in the money. Exercise can also be cash only, but can only be done on the date of expiration. So we talked about American style options and we talked about European style options. American style options, you can be exercised at any time within the expiration of those options. A European style option is when you can only be exercised at the last day, the day of expiration. And European style options are usually done in cash, okay? And those are indexes like the SPX that we were looking at, the NDX, which is the NASDAQ 100 cash settled index, the RUT, the RUT, which is the Russell 2000 cash settled index. Those are settled in cash, okay? All right, so moving on. In the money, the ITM, we talked about that. It means that the call strike is below the underlying security, or the put strike is above the underlying security. Okay, and we talked about that. Naked options means selling a call or put option without having the underlying security. Okay, so it means not having the shares on the underlying contract when you're dealing with futures to back you up. but it also means not having another put or call that you bought to be your stop loss, as we showed on the selling of a call spread or selling of a put spread or selling of an iron condor. All right, so out of the money, the call option is out of the money if the call strike is higher than the underlying security. For example, the call strike is 100 and the underlying security is trading at 95. The put option is out of the money if the put strike is lower than the underlying security. For example, the put strike is 90 and the underlying security is trading at 95. Okay, we talked about that. The put option. The buyer of a put option has the right but not the obligation to sell at the strike price. The seller of the put option has the obligation to buy at the underlying security at the strike price. Okay, so this is, once again, this is the showing of the concept. If you are the buyer of the put option, let's say you're buying this $29.50, then you have the right but not the obligation to sell the SPX at that put strike. Okay, and if you are the seller, then you have the obligation to buy. You have the obligation to buy from the seller at that point. Okay, at the $29.50 strike price, and that's usually not done until this 29 strike price is in the money. So this at the money line would be above it. Okay. All right, so at the money line will be right here. All right, so let's clear this and move back to the definitions. All right, so selling an option. When you sell an option, you receive premium instantly in your account. Okay, we talked about you being like the insurance company writing policies, you're getting capital into your account. It's a credit. Okay, the short call spread, we talked about the short call spread. It's when you sell a call option and buy a higher call option simultaneously. For example, selling the 100 strike call and buying the 105 strike call. The short iron condor, we discussed that as well. It's when you sell a short put spread and a short call spread simultaneously. The short put spread is when you sell a put option and buy a lower put option simultaneously. For example, you're selling the 100 strike put and buying the 95 strike put. Okay, we didn't talk about this, but a short strangle is when you sell a naked put and naked call at the same time. And a short strangle is, I believe I showed that a little bit earlier, but didn't mention it that was a strangle. And let's just say you're selling the 2900, you're clicking on the bid on the put side, and on the call side, let's just make this, say you're selling the 125 on the call side, and you just click it on the bid. And if you go to the curve table, you'll see what this looks like. Let me drop this down. So basically, this is the strangle. You have risk all the way down to 0 on the put side, and you have unlimited risk theoretically on the call side because you are uncovered. Okay, you make money if it stays between your short and your short call and your short put. This is similar to an iron condor, but the iron condor doesn't have risk all the way to 0 or theoretically unlimited risk to the call side, because you have a put that you bought for stop loss and a call that you bought for stop loss. Okay, so that's how a strangle looks. I don't consider it a basic strategy, so we really didn't discuss it that much, but it is on this definition so you can understand that. All right, the strike price. The strike price is where the option can be bought or sold on an option chain. The strike price determines if the option is at the money, in the money, or out of the money. Okay, so we discussed the strike prices and how they are standardized and how you can buy and sell at the strike prices. Now, the strike price determines if you're in the money or out of the money. So once again, this is or at the money. This is the at the money line on the TastyWorks platform. So if you buy something on the put side below the at the money, then you are out of the money and you don't have to really worry about exercise until you're in the money. So if you had an option over here that was in the money, then you have a probability of being exercised, and we discussed what exercise means. And it's the same type of concept on the call side. All right, so let's move on. All right, so the last definition we want to be aware of is the underlying security. Okay, the underlying security could be whatever you are trading, such as a stock, an index, or a commodity. So the underlying is just what you're trading. What we've been looking at primarily today is the SPX, which is the S&P 500 index. This concludes our presentation on the basis of options. If you enjoyed this video, please consider subscribing and liking this video. We thank you for watching.